So I want to show you a trade that I took that I'm about to lose tomorrow, and the trade was on sugar. I'm going to explain to you exactly how I got into this trade, where the price is now, and what's going to happen tomorrow when the futures contracts roll over. So this is a weekly chart on sugar, and I'm going to stick to the weekly chart because it's easier to illustrate to you rather than looking at the ins and outs of the daily charts. I've got a level drawn in here in this yellow zone, which is at around about 20.5 cents per pound, and I'll tell you the reason why I've drawn this in here. And it's an area of interest for me in terms of resistance. After having moved up from around about 17 cents per pound into the 20.5 cents per pound region, I became interested in selling sugar futures on my broker at Black Bull. So I entered my first trade position at around about 20.5. I'm not going to say cents per pound every time. I'm just going to say the number to make it easier. The reason I've got that yellow resistance level drawn in is for several reasons. First of all, it's a previous high that we reached during 2021 and 2022, a clear resistance level at the top of a long move up, way out of the sort of median range of sugar, which is in around the 15 to 20 cents level. It's also where the 78.6% Fibonacci level is of the move down from this high to the bottom and back up again. And that's why you can see 0.786 written in over there on the left. So not only is it a previous resistance level and a 786% Fibonacci level, it's also the previous highs that we reached over here going back all the way to 2017. So I drew it in as a resistance zone rather than a specific resistance level, but I started selling at the bottom of this area at 20.5, which is where this green line is. And then I added some positions as we moved up slightly higher up to about 21.5 to 21.6 in order to complete my short position on futures, knowing that I had a full month before the contracts rolled over and I had to exit the positions. Above this yellow zone, we've also got another resistance level, and that's the high going back to roughly July 2016. That's this level over here. And I was prepared to add further short positions on the sugar futures up until about that level over there, which is at about 24 cents per pound. You can see this all took a little bit of time, and by the time we got to 24 cents per pound and just slightly higher than that, I was prepared for a slight push above it and below. I was prepared to continue holding onto those contracts with the idea that the price would then begin to move back down towards my entry level, which would now act as support, and with a bit of luck break down through these moving averages back down to about the 17 cents level. However, that's not what happened, and the price continued to rally through 24 cents up to 26.5 cents where it is today. After breaking through 24 cents and holding above there, I was forced to hedge my position and lock in a maximum loss acceptable to me and my clients, and that's roughly around about 2%, actually slightly less than that. So the situation now is that I'm locked into a slightly less than 2% loss with the futures contracts rolling over tomorrow at my broker Black Bull, which means I've got to take the 2% loss and then decide whether to re-enter those futures contracts. What this little example does is it illustrates two things. One is that the market can continue to move higher against expectations when there are surplus supplies coming out of Brazil, but there are problems with India and various factors with weather and supply and demand and storage that have affected the price of sugar in an extraordinary manner. Sometimes these things can't be accounted for, including potential manipulation through market players in the price of sugar. And the other lesson that can be gained from this example is that when you reach a maximum loss level that's acceptable to you or your clients if you're trading money for other people, you need to then cut those losses or hedge those losses depending on your trading methodology. In my case, when I'm trading commodities, normally I tend to hedge my positions rather than taking a loss, and that gives me more flexibility in managing the trade position. The end result of either hedging or taking a stop loss is that you've locked in your loss at a particular risk level, which I've done here, and that happens to be just below 2%. So tomorrow morning at the rollover, those positions will all close, and I'll take, I think it's 1.9% loss, and then I'll have to reassess my position on sugar and decide whether I want to continue to sell, depending on the rollover price into the new futures contract, or whether to leave sugar alone and wait for the price to either move higher or lower or stay where it is, and then decide what to do with sugar futures. I think overall though, I'd still like to be selling this contract, and I'm still waiting for a move back down towards the 20 cent level and then potentially back down to 17 cents. So I hope you found that useful, and I think it's a good illustration of, first of all, honesty in showing you that professional traders also lose trades. We're not perfect. We don't get everything right. And also to show you that it's important to manage your risk and that markets can remain irrational for a much longer period trade, then you can remain solvent in your trading account. So that's sugar futures, and these lessons apply to anything that you might be trading, whether it's commodities or stocks or Forex or anything like that. And it's really important that you understand these lessons. No one would have thought that sugar would have gone up from below $10 in 2020 to almost $28 in 2023. Unfortunately, in this particular market, there are a lot of traders and funds who have been caught short on sugar, and they're all scrambling to adjust their positions and exit their trades, adjust their hedges, and do whatever they can before the futures rollover takes place tomorrow or the next day, depending on your broker. The good news about trading sugar is that the futures only roll over every 2 months. So if you're thinking about selling sugar futures this week after the rollover, you'll have another 2 months to manage your position. Well, if you found this useful, please give the video a thumbs up, and if you're new to the channel, consider subscribing.